Hello, everyone. Welcome into episode 3 of Conversations from the Canopy. It's the first of the month, the 1st of December. 'Tis the season for tax loss harvesting and tax alpha. So I've brought in no other than my longtime friend, Frank Ferritto, who has a decade plus experience in wealth management, thus is well equipped to have an incredibly valuable conversation on the topic. After we get that out of the way, we really get into our bag and expand the conversation to a host of other topics. We touch on the evolution of the 60/40 portfolio to account for new asset classes, including private equity and crypto, and longer lifespans from GLP-1s. During that conversation, him and I talk quite a bit about private equity. And in a way, I think the conversation we had is extremely valuable to those exploring an allocation. We both make really great points. I think we both agree that it makes sense for some people, but there are some nuances there that many don't have the time to talk about on air or have time to really get into that I think is valuable for people to understand or account for in their calculus when exploring an allocation in private equity. Then we pivot the conversation to get Frank's take on the miraculous performance of ex-U.S. equities, precious metals, and small to mid-cap U.S. stocks, and if this miraculous performance can continue into 2026. Finally, we close up with some thoughts on how increased political polarization influences investment risk. This is a really packed episode. Him and I talk every week anyway, so it's really nice to expand the conversation and gear it towards a more general audience because me and him learn a lot talking to each other, and we think that you guys will learn a lot listening in. I'm excited to send you in. I'll do it now. Thank you so much, and I hope you enjoy. Hello, everyone. Welcome in to episode 3 of Conversations from the Canopy. I've brought a very special friend of mine to speak with us today. His name is Frank Ferritto. I'm going to allow him to introduce himself. Go ahead, Frank.
Yeah, Donnie, thanks for having me. Always a pleasure. My name is Frank Ferritto. I've spent 13 years plus in the wealth management industry at this point, so have a lot of experience in that world. It keeps me connected to what's relevant today in the news cycle and financial instruments and investments. And then also from a planning perspective, I think it gives me, as it pertains to planning, a good perspective on how that can relate to the investment world, politics, and again, what's going on in the world. So we thought, Donnie, I'll let you run for it from there, but we have these conversations regularly and we just kind of thought we'd make it in public.
I think that's a great way of summarizing it. Today, we're going to talk about a couple topics in particular. And before we jump right in, I do want to simply say Frank's kind of undersold that he's one of the most intelligent, hardworking, and high character, high integrity people I know. For those of you that thank me for the work I do and the advice, well, not advice, I'm not really in the advice business, but the content and the education that I put out, you have to thank Frank as well. He was the one who gave me my first shot in the industry as an intern. Now, oh my goodness, I'm going to start feeling old. A decade ago, a whole decade ago.
Yeah.
Then Frank didn't have, you weren't married then either. So you were
No.
probably as old as I am right now.
Yeah,
So,
we were in the early parts of our endeavor into this industry.
yeah.
So yeah, we crossed paths at UBS. We've continued to work together with the firm I'm at now. And I think we both come with some really good experience and background. Both have helped each other grow and learn a lot. I'm looking forward to this.
Excellent. So we're going to start with tax loss harvesting. This is going to come out sometime in early December. I figure we'll be talking about it then. A lot of people know about tax loss harvesting. They've heard the buzzword, and I think most people casually view it as just sell your losers at the end of the year for tax purposes. Does that seem fair?
Yeah, it does. You're right. It's a word that's tossed around a lot. It sounds good, but there's a lot of nuance to it, I think. Generally speaking, if you have gains throughout the year, what you'd like to do is essentially offset a lot of those. Or, if there aren't gains, a lot of people will hesitate and not trim losers, but those can be harvested as well. Only 3,000 can be offset against income, but anything above and beyond that can be rolled to future years. I think, years like 21, 22, where you had the market down pretty significantly, a lot of people didn't have gains, so they thought, I'm just going to hold these things, they come back. Well, what you can do is you can actually take those losses, harvest them, and then use them in the future to offset gains when markets do come back. So that's proper planning. To kind of rewind a little bit, look, in our industry, there's obviously alpha that's added through investment research and analysis and whatnot.
Right.
Well, the new buzzword too is alpha added through taxes. I mean, mitigating taxes is enormous. And so tax loss harvesting is part of that conversation.
Is that just
So
called tax alpha? Is that the buzzword?
yeah, yeah,
Okay. Yeah.
that's what's being thrown around, tax
Before you
alpha.
get too far from that, you mentioned something that I do want to ask about because you mentioned there's a nuance to this process. And before we go down the road of generating additional performance on a post tax basis, I want to talk about you mentioned that in 21, 22, there were some losers that people thought would eventually come back. But because you can harvest some of these losses and because you can use it to a tax advantage, that's a reason to sell anyway. What if you decided you bought a stock that you believed in, right? They've been performing well. It's just the sector's out of favor. Maybe the valuation just isn't being appreciated the way you think it should be. In other words, the company is doing what you believe it should be doing. The thesis isn't broken, but the stock is still down. I've heard that what some people do is if they feel as though it's a valuation issue and not a company issue or not a performance issue, they'll sell it anyway. And then a month later, after the wash sale is over, they'll buy it back, adjusting their basis to the new lower price. Does that make sense to you? Or would you just be in the ballpark of if you believe in it, don't sell it because the thesis isn't broken?
Yeah. This is where some of the nuance comes in, right? One thing that we will do for clients sometimes is if the assets are there, we'll double up on the position. Okay. And in
Right.
30 days, you'll sell the original cost basis. And that gets you that loss. Now that's got to be done before December, right?
Right.
Because
Of
you got
course.
to take it in that tax year. So by the time this comes out, I don't know if that'll be an actionable idea, but that's one strategy. If you're worried about a catalyst on the horizon that may let the stock run and you don't want to miss out on any of that. Otherwise, sometimes catalysts are surprises. So there is a little bit of a risk, but
Right on.
generally speaking, within a month's time, if a stock's under pressure, for the narrative to really turn around and get the stock to start running again, it takes a little bit more than that. So I think I would usually err on the side of let's take this loss and we can buy it back. The loss is valuable to us. Depending on the situation, are there gains that need to be taken? Or are you just taking the loss to harvest it for later? That's kind of the things you need to weigh and go through when you're making that decision. But if there's a big gain and we've got a big loss that we can use to offset it, and there's not a big catalyst in the next 30 days, let's sell it. We can buy it back, reevaluate the decision then.
So, in other words, if you have a taxable gain, there is value in the loss, or there's more value in the loss.
Absolutely.
Sure, that makes sense because you have to pay those taxes on capital gains if you don't have something to offset them in that year. Like you can't wake up January 2nd or January 1st, whatever the first trading day of the next year is, and
Right.
sell a loser and offset. You've already
Right.
made the gain for the year. Now, that's a
Yep.
good point. Another question before we move on to a little bit on tax alpha, if you want to go into that, for 30 seconds, but the idea of if you don't see a catalyst in the next 30 days, but let's just say, you don't know, and you say there are surprises, just for the sake of argument, I'm not saying this is a good idea, but this is actually how I like to use call options. And it's a little bit different from most people that use them for speculation. But if I'm losing faith in a trade or in a company and the loss is there or we're even, sometimes I'll sell it and I will get the equivalent amount of options contracts that would replicate the position if I were to exercise them and just put it a month or two out. So then when I do exercise it, I'm past the wash sale date. And if it's gone well, then I get my position back, albeit at a slightly higher basis, but at a price that I'm more comfortable with because the event is cleared.
Yeah. Yeah. I love that. That's one way to do it. Another, idea that's come to mind that we'll use for a lot of clients is it's not necessarily stock specific. International markets for a while lagged. Small caps, mid caps lagged. We had losses in a lot of those funds. Maybe it's a mutual fund. We swap it to an ETF. Maybe it's an ETF. We swap it to a mutual fund. You still participate in that asset class. You still believe in that asset class. You think there's great value there, but you're able to harvest that loss. Same
You're
idea.
talking about like a substitute.
Yep. Yeah.
Yeah. So you could do like VOO for SPY or something like that because they're technically two different vehicles.
Yeah. Yep.
Just because I'm just using those because those are very well known to, everybody.
Exactly, exactly. Those would fall in that category, I think, as well. The options are obviously a little bit more complicated for a more novice investor, just swapping, funds is a great strategy. But if you're talking specific stocks, yeah, that's a great idea. Some people too will, if we're talking stocks, maybe it's just the sector that they're attached to and they own
Yep.
Palo Alto and they'll roll it into CrowdStrike. Now you probably don't have a loss in Palo Alto, but you
I
get the
hope not.
idea. We'll pick the cream of the crop. Sometimes there's 2 or 3 players where we can rotate in and out of. So that's another way to kind of manage those taxes and add alpha.
And this is a bit of it's funny you mentioned that you don't have any losses in Palo Alto, and I said hopefully. I remember in 22, we were getting into like the ninth and actually it ended up being the end of the bear market in October. And I remember I woke up, I was actually in Chautauqua with some friends for I think it was Labor Day, and the S&P opened at 3,600 and that was it. I think that was the 9% CPI. That was the crazy, like, everyone's like, can't get any worse. And I remember a week before that event staring that down. And that was when JPM was like, you nibble at 3,400, you eat at
Yeah.
32, and you go, yeah, you remember the time.
Yep.
I remember talking with you. I was holding bags in Google, Amazon, and I think one other. But the point being, we were talking about like, do I hold this or do I just try to time this lower at the bottom? And I remember walking away thinking to myself, I am not going to be the only investor in history to lose money in Google and Amazon. It's just
Yeah.
not happening. So I
Yeah.
obviously held it, worked out well, but like sometimes that stubbornness, that's how I feel about cybersecurity today. I am not
Yeah.
going to be the one to lose money in cybersecurity. I'll hold this crap.
Yeah.
Not going
Yeah.
away.
Yeah.
So
And all the things we're talking about, that just, it's an ode to like easier said than done. And I mean, every
100%.
every
100%.
situation has its own variable and twist. Even your mind starts to play games and make excuses. If you try as much as you can to come up with a plan that you think makes sense and stick to it, and then to your point, when things get hairy, you can go back to that plan because your mind will, and emotions start to creep in.
Next topic here. You mentioned in the open, do a lot of financial planning. One of the key inputs in financial planning is your age. It drives your time horizon, which informs your allocation between stocks and bonds. Younger investors, and I mean, you know this, but just for the sake of someone who has no idea and is listening, and younger
Yeah.
investors, you tend to lean heavier into equities, a little bit more risk, a little bit more reward, and you shift into fixed income or bonds the closer you get to retirement because you can't afford for there to be a 20% drop in your portfolio's value when you get closer to going into retirement.
Right.
We see these in the target date funds. You can get them in your 401ks. I had one, whatever year you think you're going to retire, you put your money into
Hmm.
that vehicle, and over time, it shifts your allocation between stocks and bonds accordingly. I think we may have forgotten or lost sight of the fact, thanks to the proliferation and popularity of AI, that these GLP-1s have the potential to positively impact our longevity. So, from your perspective, does that traditional glide path we use for investor age make sense? Or is it time for younger investors specifically that will benefit from these GLP-1s stretch the glide path to account for extra years?
Yeah. Yeah. I love this question. Clients ask this a lot in many different ways, not just as it pertains to GLP-1s, but I like to reframe how we view that question with everyone because I think, look, gone are the days of I'm 65 years old, so I should be 65% stock, right?
Right.
Like I should be in that 60-40 portfolio. I think it's easier to reframe the conversation around your goals and what you're trying to accomplish. Let's say you're 65 years old, right? And now all of a sudden these GLP-1s come out, you've lost a ton of weight and you feel like you're going to live a lot longer. Or maybe there's just this risk. It's a great risk, but a risk to your plan that you're living longer, right?
You
I
outlive your
think, sure. We also went through this decade of like lower interest rates, which made, that conversation difficult too. So if you bring it back to, look, what are my goals in the next 3 to 5 years? And not even necessarily goals, but what do my expenses look like? Am I retired? Am I spending, let's just say round numbers, $100,000 a year? I know I'm going to need $100,000 for the next 3 years. That should be invested very conservatively.
That makes sense.
Maybe you want to add a buffer to that because you've got a kid getting married and it's going to be a $20,000 to $30,000 expense. Maybe You want to add a buffer to that because you want to buy a boat and travel a little bit during retirement. Whatever you come up with, if it's money you're going to need in the next 3 to 5 years, generally speaking, we like to keep that very conservative. Above and beyond that, you need to be in riskier investments, and risky, not, buying quantum computing small cap stocks. I mean, like,
Right.
you need to be in public equities, because ultimately that's where your best growth is going to come from. And to your point, we need to continue to grow that part of the portfolio to help fund those living expenses when you're 75, when you're 85, maybe when you're in your 90s. Everyone's situation is different. So how that applies too is, like, for someone listening, maybe I'm spending 100 grand a year and I need the next 5 years, I need $500,000 kept very conservative. If that's all you have, you're 100% conservative. I'm sorry, but you can't afford to be taking that type of risk. Maybe you also shouldn't be retired, but that's a different conversation, right? Yeah. Again, we could play the game, because here's the other thing. We have a small sample size right now. And truthfully, our software, until we get, years of this data showing lifespan has improved, our planning software is not going to factor that in just yet. In the industry, it really won't. No one's going to make a knee-jerk reaction to some of this data until it's proven that it really is. And you can make the case it already is. And so that's neither here nor there. But I think if you always bring it back to your goals and what you're trying to accomplish, that will get you to how you should be appropriately invested, no matter how old you are. It also helps through times of volatility. As long as you have the next several years of expenses protected, other than, the big blowups, 08, 09, the dot-com bubble, which is an outlier because essentially you'd have to be fully invested in the NASDAQ. There were other asset classes that performed well through that period. If you're in a diversified portfolio, it's rare that it takes 3-4 years to get back to where your portfolio value was. Even if you're 65 years old, 70 years old and retired, you're spending down that bucket, that $500,000, while you're letting your stocks recover. And then once they fully recovered, we rebalance the portfolio and we replenish that expense bucket, if you will. That's kind of our way of managing through that type of dilemma. And you can apply that to anything beyond GLP-1s. Just expand your time horizon, no matter, whether you're younger. Who knows how long people our age, will live.
Right.
I look at my situation in the sense that, okay, what expenses do I have coming up? Buying a house, saving for college here and there, which are years down the road for my kids. Otherwise, the rest is invested in stocks. That's where the best growth is going to be. And I think there's some other asset classes, and I think we'll get to that later in this conversation. But that's kind of my long-winded answer of reframing how you view that subject, longevity and asset allocation.
What I'm getting is, when they say 60-40 portfolio, it's not 60% NVIDIA, 40% Rigetti. A little bit more conservative.
Yeah.
No.
Yeah. There'd be some tax loss harvesting being done there.
For sure. So let me ask you one more question about this topic before we move on to these other asset classes that you alluded to.
Yeah.
Do you think, obviously, you're saying it's not being taken account for in like the Monte Carlo simulations and all this stuff yet, because there's not enough data, and I think that makes sense. But from a broader macro, or maybe macro is not the right term, maybe it's mechanical perspective. We have all of this money that in the United States through your 401k every 2 weeks gets invested in the S&P that's price agnostic. If target date funds that manage a lot of money start to tilt toward stocks for longer, isn't that just another mechanical, if you will, tailwind for stocks, like another price agnostic buyer for longer? Or rather, it's the same buyers buying stocks for longer?
Yes. So if I understand you correctly, like, these target date funds will maybe, should we assume they're getting a little bit more aggressive technically?
Eventually they will.
Relatively, we'll call it.
Well, right, because I think part of the reason the United States has done so well is the demographic trends in the country, which are still favorable and I think are supposed to remain favorable until actually, I don't remember so we got another decade or two before skeptics are worrying about that. But if this elongates that cycle.
Yes, I think that adoption will be slow, and here's why. This is just my opinion.
That's fine. Yeah.
There's so much like liability risk in there that I think they will tread lightly before they start to do something like that.
Do you know if those guys are like fiduciaries as well? Like the people that
Yeah,
own the target date funds? Yeah.
they have a fiduciary responsibility to protect those assets before growing those assets. And so I think they'll always lean that way, but they give you the option in your 401k plan to select those or build your own too. And so that's why I think also like, look, you can leverage us. We're going to be a little bit more risk averse, or you could do
Mhm.
it yourself.
Fair is fair.
Here's the other
Yeah.
comment I'll make on that. In all of our planning, I've been with 2 different wealth management firms now. I've seen a number of others. We all use similar software. Our plans all start with a living age, an expectation of living
It's
till,
per person.
yeah, 92 for men and 94 for women. What is the life expectancy rate like in the late 80s for people now? So
Right.
we're already very conservative in that planning. Like we're hoping for the best, but kind of
In
planning for the worst.
You're making the point that the estimation on age is already generous.
It
And like
is.
how much more generous can you be?
Yeah,
Right. Okay.
exactly.
That's
And
fair.
and I have, sometimes I'll have clients say, my parents didn't live until their 90s. My grandparents didn't live until their 90s. I'm not living until my 90s. We still won't touch the number. Like I rather tell you when you hit 75, you could spend a few extra dollars as opposed to, and again, I don't know. We just have somewhat of an optimistic lens. People are getting healthier and living longer.
Right. Well, no, not only that, it's as a fiduciary, someone put myself in your shoes. If someone turns 75 and the talk is, hey, if you want to help your kid with that down payment, or if you want to go, have one last ride in Vegas, go for it.
Yeah.
Instead of, hey man, when do you think you're checking out?
Well,
Yeah.
that's just it, right? The last thing you want is like when you hit 75, wishing your health was worse because
These
financially
are
aren't going to make it.
these are high class, high quality problems.
Yeah, yeah,
If you're on one side of that ledger for sure.
no doubt.
Uh, I know you remember, but for those who probably weren't paying attention during the COVID, or sorry, not COVID, rather the 2021 valuation compression recession, whatever you want to call that.
Yeah,
Everyone was declaring the 60-40 dead because stocks did nothing and bonds did nothing. In fact, they both went down. It was like the first time in decades that we'd seen the 60-40 perform that poorly. And it's opened the door for the conversation to talk about another allocation bucket. So 60-40 generally being stocks and bonds. People are talking about 60-20-20
hmm,
or
yeah,
60-20-10-10. The other one or two buckets being private equity, now that there are lower minimums and it's a lot more accessible, and the other, of course, being cryptocurrency. Specifically, due to the ETF proliferation, we just got one for Solana and XRP. Some of the cutting edge brokerages like Robinhood are letting you just hold your crypto in the same place that you hold your stock. So I guess the question is, do you see a world, whether it be a decade, 2 decades away from now, in our lifetime, where we start hearing or seeing people talk about 60-20-10-10 or 60-20-20, where the other allocations we discuss are crypto and private equity?
yeah, yeah. I truthfully, I think it's here already, and I think it's here to stay. And I think generally speaking, anytime you're adding more asset classes to your portfolio, you're technically diversifying yourself more. So that's healthy in a
Mhm.
sense. BlackRock, one of their year-end letters was talking about it. To your point, the 60-40 is now a 60-20-20 or a 60-30-10, with that last piece being alternatives. We'll call it alternative asset
Sure.
classes, not public debt or public equity, but you've got private equity, you've got private debt, which has been a great solution, and then you've got crypto, and essentially like real estate kind of falls into that bucket too.
That's fair.
And then gold, some of your alternative, commodities, those types of things fall into that basket as well. Some of those have been around for much longer, but you're kind of asking the question around this newer onset of mixing in private equity, debt, and crypto into that conversation. Yeah, I think it's here to stay. Like the original onset, anytime you introduce a new asset class that shows it has staying power and is a diversifier, I think it's healthy. I think you have to be careful with your selection.
100%.
That's where the differentiator is. I mean, there's in public equities, it's hard to miss when you pick a large cap growth
Sure.
ETF or value ETF. In the private space, that arbitrage or that difference in returns is massive. You're talking funds that will annualize at 20% versus some funds that will lose all of your money. You got to know what you're doing. You got to have some advice if you don't know what you're doing, and you got to be really selective. That goes
Right.
for private debt as well, and that goes for crypto. There's not really any scams in the private equity and debt space. Obviously crypto, you open yourself up to some scams. So, but I don't think there's a problem with the ETFs and the crypto space. I think a lot of it's proven it has staying power. If you're using them correctly in your portfolio, yeah, I think you can add alpha and reduce some of your beta, if you will, some of your risk or volatility by mixing into asset classes.
A couple follow-ups. The first being, when you say a new asset class shows staying power, what kind of time frame is required? Generally speaking. Obviously more than a year, but do you need 10? Do you need 20? Or is like 5 good?
It's a great question, because when I think of something like Bitcoin or cryptocurrency, is that something I'm thinking of it through market cycles and different changes in economic environments, right? And so I'm careful answering this question because it's something that maybe someday could be disrupted, right? But so can Apple and their iPhones, right? And so
So can anything.
so as far as staying power, I'll go back to through different market cycles. I mean, we've been through low interest rates, we've been through high interest rates with crypto, we've been through a few bear markets with crypto. It continues to gain adoption through those things. I think you look at the trend too. It's gone from the wealth management firms wouldn't touch it to now we're open to allowing clients to buy ETFs unsolicited. The
Yeah.
next domino to fall is solicited. The next domino to fall is now you see companies putting it on their balance sheet. We've seen a few. I'm assuming there's more to come if the trend continues the way it is. So when I say staying power, I think that's what I mean.
No, that's reasonable. So yeah, to your point, it's gone from rat poison, to quote the late Charlie Munger there, to, potential asset class.
Yeah.
You touched on something that I just want to double click on real quick. You mentioned unsolicited versus solicited. For someone who doesn't know what that means, just in a sentence.
So I don't know of a firm yet that can recommend buying crypto to their clients. I am not doing that either. But what I'm saying is, if a client calls and says, I'd like to establish a position in a cryptocurrency, we'd be able to tell them that there's ETFs. We cannot buy the true coin. You can allocate and benefit from the increase in price by buying an ETF on their own, unsolicited, meaning it has not been solicited by the advisor. But something the client initiates.
Can it be in that client's account at that firm, or do they need to go and do it on their own?
It can be in that account. It's got to be outside of advisory, because remember, if we have an advisory relationship with a client, we're advising them on it. Even though we're not soliciting that purchase, we are doing due diligence on all the positions in that account. Yeah.
Yeah. Before we talk a little bit about some of the other asset classes or, broader buckets, there is a thesis that some people are sharing. One of my favorite guys, Josh Brown, is definitely a proponent of this. His concern about the democratization of private equity, I think, is reasonable. And it's the idea, and you alluded to it earlier, that selection of manager matters a lot more in that specific asset class than it does anywhere else. And the idea that we're going to basically be incentivizing or creating a environment where more people are going to want to get into private equity and have these funds, you're going to create an enshittification of the asset class, because in private equity, there's only so many good deals to allocate money to. Just because more people show up to put money into deals doesn't mean more good deals show up. His general thesis, I hope I'm not misquoting him, or at least the way, or rather, here's how I understand it. When you get more people participating or trying to participate in a certain investment strategy, you're inevitably going to get some people that don't really know what they're doing, and the returns are going to suffer. So unless you're extremely savvy in picking your manager, you might want to reconsider putting serious money towards it.
I'm looking up a number to make sure I get these statistics right, but I'm going to talk out of both sides of my mouth because I've thought about this a lot, right? Like anytime money is flowing into an asset class and it's super hot and everyone's talking about it and everyone wants exposure to it, it raises a little bit of a red flag, right? There's that. And then you hear your own little local stories about mom and pop HVAC company had to sell to PE because they offered them a crazy price they never thought they would have gotten. And then it spirals into the narrative, well, there's all this money pouring, as you said, pouring into the space that they got to go somewhere with it. Yes, that's true. That's what leads to the need to be picky about your selection process, because you want to own a manager that's being really picky about their selection process. Also, when these funds get too big, they should be closing down because, to your point, like from a fiduciary responsibility, I don't know if they have them or not, but they shouldn't be taking on more capital if they have nowhere to go with it, because then you make excessive risk. However, and this is what I was looking up, maybe we fact check this later, but I believe there's like 10 times more privately held companies, maybe even more than 10x, than publicly traded, right? So if you look at it from that perspective, even though there's a lot of capital going into that space, there's still a lot of places to go with it. Also, I think you have more and more, that number's growing because you have more and more people staying private longer. They don't want to deal with not only, just the whims of daily price activity, but meeting quarterly earnings, activists, investors coming in and telling you what to do. So a lot of companies are staying private longer, and it's creating opportunities. So now you're seeing, for example, Robinhood is starting to offer, which is really interesting. I don't even want to get to the technicality of it because I don't fully understand it yet, but how they're essentially allowing people to invest in something. And I believe it's just in Europe now. They're working on SEC approval or FINRA approval, whatever, in the US, but allowing people to invest in a privately held company like SpaceX, right? And people want exposure to that. And I think it's really cool. That's part of that democratizing and bringing that to, originally that was like, it wasn't even the ultra high net worth investor. It was like you needed to know someone to get on those sorts of deals. Now, Robinhood, which has been their brand from the beginning, is bringing that essentially to someone with $100 and a Robinhood account's fingertips. I think you just have to be careful with what you're getting into, but it's only going to grow from there. If you use it correctly and you go back to framing the conversation around how much risk can I take and do I have enough to cover my short-term essentials, then great. Everyone should have access to these things. And it also, on the flip side, it's brilliant. Capitalism thrives off capital, right? If we can pour more capital into the private space, upstart companies, businesses that need juice to get their business going and need funding, essentially, like Kickstarter. It's kind of like Kickstarter, right? There's a lot of companies that have bloomed off of getting funding through Kickstarter. Well, now you've got it on your cell phone where anyone could pitch in. While there are risks to it, it's awesome because it's going to breed some incredible companies that come out. It's really what's made the U.S. the forefront of investment. We dump capital into ideas and we allow those ideas to bloom and blossom. And so part of me is like, yes, there's some risk and it's a little bit concerning. And certainly these companies are, because of the flow of capital, they got to put it to work. And so they're overpaying for certain things. And so it worries you from that perspective. But at the same time, it's going to open up this whole new world of growth, especially in the U.S. markets and especially for investors that pick the right things.
That's great insight. I think you laid out the case very well, because if you have the capital to give and you have a management team that's been entrusted to deploy it, they can find a fantastic opportunity that probably would have been overlooked by a bank or some sort of other lender. And that's something I really hadn't thought of. So that's spectacular.
Yeah. I was just going to say, the U.S. is, it's buyer beware, and it's capitalism at its finest. There are people who've made investments and lost everything, and there are people who've made investments and it's completely changed their life and created some of the most amazing companies that we have today. Amazon, Google, Meta, all of them started from ground zero, and they got funding in much more difficult fashions. It excites me for someone trying to start a business now that's going to have easy access to capital. Yeah, there's going to be some carnage, but as an investor, if you choose appropriately and it fits appropriately into your asset allocation or holdings, you'll be fine, and you've got the opportunity to do really well.
Awesome. Perfect. So from private
I
equity.
think you were going to say something else.
Oh, I was only going to add that The number one rule in investment banking is the price you pay. That ultimately determines how well you do. Your return is based on your purchase price. If you have more money chasing the same deals, you're inevitably going to pay more, which means that even if you select the right guy who's going to say no when it's right to say no at a certain opportunity and say yes when it's time to say yes, even when you get that yes, the price is going to be higher than it otherwise would have been. And I honestly think that's the biggest risk. I don't necessarily know if there's going to be an enshittification because people that aren't or shouldn't be in the business of managing a private equity fund are going to start one and their marketing is going to be better than their product and they're going to be able to get a bunch of capital in there and it's going to go, tits up for lack of a better term. I think it's just going to be the difficulty of when more people are interested in finding the next XYZ, this, that, the third, you're inevitably going to pay more for it, which is going to change your return profile.
Yep. Yep.
Maybe that
Yeah, I'd
all,
agree
but
with
I
all that.
think, yeah. So from private equity to other, I don't know if we call them asset classes, but buckets, commodities, ex-U.S. equities, the price action we've seen specifically there in gold and ex-U.S. equities is nothing short of miraculous given their priors. Just completely unexpected. I think a couple years ago, you and I were joking that, like, I don't know what scenario could happen to where we see outperformance in ex-US or that there's all of a sudden going to be a rush for gold. We'll skip the lead up because I think most people understand why. But personally, I view each of these asset classes or equity buckets, gold, I guess it's a commodity, and ex-US equities performance to be driven primarily by the historic weakness in the US dollar. If you look at the first 6 months and now the first 10 months of the year, this is the worst in 1 or 2 decades for the US dollar as measured by the DXY. For those that aren't familiar, the value of gold generally is inversely correlated to the dollar. And if you're talking about the ex-US equities, a weak US dollar means a stronger foreign currency. When you translate foreign earnings back into dollars, it looks a lot better. So, in other words, for the first time in, let's just say, 10 years, the US dollar isn't just kicking the crap out of the earnings coming out of every country that's not in US dollars. I'm a believer that if USD reverts, you're going to see a performance in reversal as well, especially if it's aggressive in fashion.
Yeah, I would agree with that. I think the dollar has had a huge impact on ex-US companies in general. The waters are getting a little bit more muddy. For example, there are some outliers. Spotify, a company that performed really well based out of Sweden, was able to elude those geographic borders and elude the effect of the dollar. But generally speaking, the price action of the dollar will dictate a lot of times how those equities perform. Predicting the price action of the dollar proves to be really difficult, which proves to predict how these international markets move as equally difficult. I think you framed it perfectly in the sense that, like, international markets, gold, like those usually are those asset classes outside of the core allocation, and they will flare up and outperform during periods where the dollar is weakening and maybe US markets are trying to figure themselves out. But generally, and this kind of ties back into Spotify, like, you want to be where the growth is, and it's been in US companies regardless of what the dollar does, right? So the less macroeconomic factors we need to predict, usually the
That
easier
makes
it is
sense.
to allocate to that asset class.
It's just another variable that needs to be taken account for and
Yep.
hasn't really gone the way of those two assets in particular for the past half decade and longer from a performance standpoint. There's one other, oh, how should I put it? One other cohort of stocks that I think has benefited from the depreciation of the US dollar, the small and mid caps in the country that send a lot of products overseas because for the first time, in a number of years, because the dollar is weaker, foreign currencies are stronger. So when US goods are being shipped overseas, they're actually cheaper on a relative basis, despite actually rather they're cheaper on a relative basis than they have been over the past 5 to 10 years and are probably priced more competitively now than they ever have been, which could be why we've seen the small and mid caps finally make a new all-time high for the first time in 4 or 5 years. Is it possible that the US dollar is helping those firms as well, or do you think there's something more?
I think that could be factoring into things, but when I think of small and mid caps, I think we've gone from headwinds to tailwinds. The market's sniffing that out months in advance in the sense that headwinds, inflation, which led to higher interest rates, big headwind for them. And then you had the tariff ball dropped on them. Those have gone from new news to old news, and now the tide is shifting where we're lowering rates. Tariffs have been negotiated out and actually come down from their peak. Inflation is pretty much dead. On top of that, we have this artificial intelligence technology that's going to, in our opinion, and why we love the space for a number of other reasons, but you have this
Talking about
trickle down
small and
effect
mid.
where these, yeah, like you could
Yeah.
make the argument, if the dollar does strengthen, is all of that offset and then some via the productivity gains, the margin expansion by adopting some of this artificial intelligence technology? We're already starting to see it. I think that's got a bigger, more meaningful impact than what the dollar does for some of these companies.
Do you feel similarly in any way about stocks in like Europe and Asia that have benefited from the dollar? Do you think the earnings trajectory there just hasn't changed as much?
I think the earnings trajectory hasn't changed there as much. I think overregulation in those countries stifles a lot of the small, mid business growth. People will point to, but those markets are cheap. They've been cheap forever, and sometimes they're cheap for a reason.
That's preach,
So
preach. Yep.
I think that's, that alludes to just specifically what you've said. I mean, the growth trajectories just, they're not there like they are here.
Excellent. I do want to say, because I think some people know this about me, I'm actually long the CWI. I have been all year. For those that don't know what that is, that's the ACWI ex-U.S. It's basically just a bundle of stuff. And I didn't get in because of the dollar. I didn't get in because earnings. I got in because the chart looked fantastic. It hadn't made a new high since 2008. It made a new high. And I'm like, all right, let's just call that a 17-year base. Let's see what can be. And I'm up 11, 12%, but I'm watching the dollar. And if it starts going above some of these, major moving averages, then I'll probably lighten up on it. But to your point, from an allocation or from the wider perspective of the conversation, it's a smaller part of my portfolio. It's supposed to diversify and hedge a little bit. Like, it's great that it's up, but it's yeah, and I noticed because it's not like a tiny, tiny part that I wouldn't note if it went to zero. It doesn't hurt, but it's not like, oh, thank God I'm a genius, right? I just wanted to throw that out there because I
Yeah.
don't want people to think that I'm being hypocritical for holding ex-US equities.
There's a time and place.
I want to finish up with a question on politics and investing. Such a great topic to end and, gather around with the family at holidays, talk about politics. We've become a lot more polarized and tribal in the country, in the US, when it comes to Republican, Democrat. I'm not talking about everybody, just people are getting louder. It is
Yep.
what it is, whatever. We're coming off the longest government shutdown in US history. And, typically these shutdowns have only ended once the polls have indicated that one party was going to suffer some electoral consequences for continuing the standoff. This time, however, the polls were very, very slow to shift, and I think it probably has to do with this political polarization. So, when it comes to politics, people are simply less willing to introduce a little bit of nuance. And in my opinion, and this is my opinion, no one else's, want to be very clear. The government shutdown this time only ended because it threatened to interfere with all of our great Congress people's holiday plans because flights were finally getting canceled because the air traffic controllers are paid by the government. That really should have been worked out a different way. Assuming this kind of polarization doesn't revert to the mean. So assuming things stay the way they are or get a little bit worse, should investors expect government shutdowns to become more frequent and maybe last as long, if not longer? And if you agree with that, does it change how you think about managing risk?
Another great question, a question I love. I'm gonna try to bring this full circle. From a politics standpoint, everyone assumes that their stance, obviously they have the confirmation bias that their party will lead to a better outcome. And as it pertains to financially and the investment world, if their party doesn't win, it's an unfavorable outlook from an investment perspective. And it couldn't be more far from the truth. If you look at the data, and no matter which way you lean, Republican, Democrat, whether they have full ownership of the House and Senate or majority, it doesn't matter. There is zero correlation from investment returns to who's in office and who's got control of office. So that goes out the window. No matter how staunch of a Republican or Democrat you are, it doesn't matter. The other thing is we've been through periods of polarization that also haven't mattered from an actionable investment. Now, I think you also have to think about, again, you kind of have to come up and understand your identity. Are you an investor or are you a trader? And if you're a trader, then sure, I think we're certainly going through a period of deglobalization, polarization, nationalism, all these different things. You're seeing it globally. It's going to create, anytime we go through periods like that, it's going to create more angst. There is certainly the risk of longer government shutdowns. I'm going to talk out of both sides of my mouth again, but that risk is there. But also, we just had the longest government shutdown on record, and the market pretty much blushed it off. I'm going to err on the side of, I don't think it's an issue. I wouldn't worry about it. It's just another one of those things that if you're a trader, maybe it affects you, but otherwise, it's just another one of those things where we look back on that chart that just goes up and to the right, and there's a little blip that says government shutdown, and you barely remember it other than looking at that chart and reviewing past history. So to me, it's just noise.
I want to quickly address the point that the market's done a good job shrugging it off. A lot of people are saying, well, because we're in the midst of an AI supercycle. Yeah, sure, but you can't asterisk that. That's where we are. It is what it is. These are the statistics. These are the facts. I'll take it a step further. I've heard some people talk about how if you look at US GDP and remove AI CapEx and AI stuff, it's only 0.1% year on year. And I'm like, well, that's like saying, chef, I'd like an omelet with no eggs. Technology drives the US economy.
Right.
It's like give me GDP without the stuff that this country does, and then I'll complain about how shitty it looks. It lacks intellectual integrity. I'm just making the point that for someone that says like, well, this time is different, I'd just like to make the point, well, every time is different. It's never perfectly analogous.
Well, exactly. And look, it's like a chicken or the egg thing too. If the economy wasn't so strong, would the government shutdown have lasted this long, right? I mean,
Sure.
Both sides understood that they could get away with it for a little bit longer because things are, had we, if we were in a recession or something, maybe this got ironed out in a week or two. I don't know.
100%.
To your point, a lot of different variables at play here, and it's hard to make any sort of actionable investment decision on it.
Right. Well, hey, Frankie, thank you so much for all of your time today. I think everyone is going to really appreciate it. In closing, is there anything that you're excited for end of year here? Personally, professionally? Anything you're willing to share?
Yeah, no, this was awesome. I think we should keep doing it. I'm looking forward to maybe hopping back on here again sometime.
Excellent. All right. Sounds like you're looking forward to the next episode. I hope everyone else is too. Thank you so much for your time today. Take care. Bye-bye.